Well, I'm going to go ahead and get started. I know we have some other people that are going to be joining us shortly. Um, I just want to thank those of you who have made it on at this point, and I will go into some introductions. I am, for those of you who have not met me, Dino Emili. I am the Executive Director of Alumni Engagement and Planned Giving at Bethany College. I was a Bethany graduate from 1978, majored in psychology, took full advantage of that and went to law school. Not that there's any relation between the two, but that was the next step. In my legal career, which spanned roughly 41 years, I spent my entire career in commercial real estate, writing leases for retail shops and office buildings. And after 41 years of doing that, I came back to Bethany, took a position in advancement, and I have been on campus now for almost 2 years, started 1st of January last year. Tonight, we're here to talk about planned giving. It'll be a basic plus introduction, sort of a 201 class, talking about what planned giving is, how to make it work for your estate and your charities in which you're interested in giving. To help explore this subject, we have two guests with us tonight. First, I'll introduce Sean Rohrig. Sean's class of 2009 from Bethany, a lifelong Wheeling resident, earned his bachelor's degree in financial economics at Bethany College. While he was there, he was one of the founding students of the McCann Family Investment Club, which teaches our students how to properly invest money for the college. He began his career in the securities industry in 2009, working for First Investors in Canonsburg, Pennsylvania. A year later, he joined the Sheeran Wealth Management Group at Wells Fargo in Wheeling. There, Sean became a financial consultant, was able to further develop his skills in managing money, prospecting, and advising high net worth clientele. Then in April of 2011, Sean joined Hazlitt, Burt, and Watson as a financial advisor and became a CFP in 2018. During his tenure at Hazlitt, he refined his trade and developed his personalized approach to wealth management. Then in July of 2021, he made the big leap, joining LPL Financial and essentially starting his own firm, Rohrig Financial, where he is today. Sean is married to Jennifer Fleeman Rohrig, who graduated from Bethany in 2011. Jennifer is the manager of business retention and expansion for the state of West Virginia, and she has also been involved in a number of initiatives at Bethany. When Sean was on campus, he was and still is a member of the Delta Tau Delta fraternity. So, Sean, good evening. Thank you.
Thanks for having me. I appreciate it.
Sure. Our other guest is Ryan Rokiski, class of 2011 from Bethany. Ryan is a Weirton native, still lives there. 2011 cum laude graduate from Bethany with a bachelor's degree in political science. He then went on to law school and graduated in 2013 from the Ohio Northern Claude Pettit School of Law and joined the firm of Rokiski and Associates in 2013. From there, he became a partner in Rokiski, Wilharm, Blair, and Rokiski in 2016, now known as Rokiski, McCune, Wilharm, and Blair. Ryan focused much of his practice on nursing home, crisis planning. He also handles complex estate planning cases where his clients seek to utilize available strategies to protect and maximize assets from the cost of long-term care. His experience makes him invaluable to families who suddenly find themselves in a crisis situation and need to quickly know how to proceed. Ryan was a member of the golf and tennis teams when he was at Bethany, and Ryan is also a Delt. So Ryan, welcome to you as well tonight.
Thank you.
Absolutely. One piece of business before we get into the substance. I just want to make a note that in addition to this evening's discussion, I want you to be aware that the Bethany website has a pretty robust site for financial plan giving interest. It's at bethanywv.edu/give. You can drill down into the plan giving tab, and it will walk you through a number of exercises to help you think a little more critically about financial planning for yourselves. Tonight's session as well is being recorded and will appear on that website in the next few days. So hopefully we'll be able to get the word out to a lot of alumni and have anybody who couldn't make it tonight sit in and review it at home. Also, just a bit of a disclaimer. The information contained on the website, as well as the things that we talk about tonight, are really shared for informational and educational purposes. Nothing's a substitute for good legal or financial advice from someone who's a professional that's working directly with you for your needs only. Nothing presented this evening or found on our website should be understood as a recommendation that you not consult with a professional. Like Ryan, like Sean, I will not be so presumptuous as to include myself in that because despite the fact that I do have a law degree, this is not my area of expertise. So just wanted to get that out of the way before we proceed to the bulk of the session tonight. I will be monitoring the chat function. If anybody cares to pose a question, I do have a couple of questions that came in earlier that I will share with our panel as we get to the point in the discussion where they're pertinent. So the first thing I want to talk about, guys, is what is a planned gift? What does that term mean in the business? And I'll just throw it out there to either of you to deal with.
Brian, do you want me to take that?
Sure.
Well, the way in my field, by the way, those were fantastic disclosures, by the way, Dino. I appreciate that. Basically planning, not just writing a check, not just, throwing your money at something and hoping it's going to work. Making a plan for what you want to accomplish. When it comes to a financial side, I help clients try to figure out what they want for retirement, how much they're going to need. Making a plan set aside that you're, especially if you are someone that likes to donate, to be able to help the community, to be able to help an institution like Bethany. That is bigger than just making a plan for yourself. It's making a plan for what you want to accomplish for that particular institution. So it is a long-term, it can be a long-term part of your plan that you're setting a little bit aside, whether that be monthly, whether it be annually, whether it be a passing, but it is to set something aside that's going to help make the institution better over time, not just, well, I need a deduction, so I'm going to throw money at this. No, this is more in depth than that. And that's where I believe, my expertise, my type of expertise, and so would be Rakitsky's type of experience and expertise is important in making a plan. So it's a little bit more in depth than just writing a check.
Anything to add, Ryan, before I move on?
Yeah, and I'll chime in. In my typical day of representing clients, a lot of it is in relation to their estate plan. So in piggybacking off of what Sean was talking about, a prolonged long-term approach to your wishes being honored, getting that in writing, getting those particular documentations in place will prove valuable, not only to making sure your goals are accomplished, but also along the way there are some advantages to you for doing these charitable gifts, and we'll get into a little bit of that in the later segments, but all of that as part of the overall plan is it's always best to have it all done ahead of time. So being able to get out ahead of it, know what we're doing, and get the tools in place to accomplish that is important. So that's part of what I do. It's part of what Sean does, and we have to oftentimes work together in order to accomplish those.
I've always felt that the idea of planned giving is a challenging one to approach people about, because it involves talking about two things that nobody likes to talk about: money and death. And so in your respective businesses, do you have any particular thoughts as to how best to approach that with someone?
Well, that's exactly what I deal with every day. You know, I deal with clients going in and out of nursing homes, probating of clients' estates after they've passed away, dealing with the family. And so I don't ever, sometimes I may come across as cold, and that maybe I don't, I'm not sympathetic enough to the situation. But I always tell clients, you know, they're in the middle of the woods but I'm on the outside. I see the trees, I see what they're going through. But it's best to work with somebody to be able to work through those things, even though it may be an uncomfortable subject. They're necessary to talk about, and talking to them with a professional helps alleviate some of those uncomfortable and unpleasant conversations.
Yeah. Yeah. And the biggest thing that we try to do, whether it be, Ryan's field or my field, to me, I always thought our job was to take the assets that you've accumulated over your lifetime and try to maximize it as much as possible towards the goal that you're trying to achieve and what the client's trying to achieve. So whether it is donating, what's the best way to make that dollar last the longest and for the best particular objective? That's really why you seek help. That's why you seek someone like Ryan. And when it comes to or anyone in that field, basically to help. I mean, there's certain trusts that we can go into later on that could be more advantageous for that, to make that dollar stretch more to what your goals are. That's really what this is all about, because you can just throw money at something that's great, but if you plan on it, that dollar can be stretched a lot farther for the client and to do a lot more good.
All right. I appreciate that. Well, let's talk a little bit about the types of planned gifts. As a novice, I thought my job was to get people to remember Bethany in their will. But it's not that simple. There are a lot of different types of planned gifts that are out there, right, guys?
Right.
Yeah, I'll start with investments like stocks, and then I'll let you have it after that, Ryan. But one of them that we run across a lot would be stocks. So, for example, let's say you bought. Well, here's an example. The last couple of years, Nvidia has done very, very well. Anyone that's owned Apple for the last 20 years have made could be life-changing amount of money. Some of these stocks have run up a lot. This isn't a recommendation to sell or anything like that, but if you're looking to make a donation, don't. One of the best ways to do it is to either there's multiple different ways. One of them, you could gift it to the organization. So, for example, at my previous firm, when I was at Hazelburg Wanton, I think Bethany actually did this a few different times, and so did a few other local colleges. They'd be gifted a piece of stock, a couple shares of stock that they made a lot of gains on. And the reason you do that is, let's say you wanted to gift the college $20,000 worth of stock that is up a lot. Okay. If you sell it yourself, you're then looking at paying tax on that stock and then gifting the remainder and having that written off on your taxes. If you gift the stock, let's say in this case, $20,000 worth of stock, the college gets to keep $20,000 worth of stock. They then own the stock. They then will have an advisor like myself or someone sell it for them, and they keep all $20,000 that they can use versus another 15-20% of that being taken away in taxes. That's the most efficient way to use that money. And then they get to write that off on their taxes. So there's more money in the client's, or sorry, more money in the charity's pocket, more that you're donating. It's one of the better ways to do that, and a lot of people just don't do it that way. That's the best way to do that.
Right.
Go ahead.
I was just going to jump in there while I thought of it. In particular with estate planning needs, taking out of the equation for the time being the conversation about protecting assets in the future, but just general estate planning. Given where we are located, we have in West Virginia, Pennsylvania, Ohio. Pennsylvania, for instance, has a state inheritance tax. And a lot of people, I can't tell you how many people I meet with to do their general estate planning. They're one thing, regardless of whether it's stock or real estate or cash or another type of investment. So many people tell me that I'm going to leave everything that I have to my son or daughter or friend or family member, and they know what I want done. Well, like Sean's pointing out, and what I want to expand on is that child may very well know that mom or dad wanted money to go to Bethany College or go to the American Red Cross or whatever other charitable organization that meant something to them. But as a result, son or daughter inherits, and in Pennsylvania would pay the inheritance tax, and then or sell the investment and realize some sort of income tax for that, and then did what mom or dad wanted and gave it to the college, all the while have negatively impacted themselves from a tax standpoint. So making sure that like I alluded to earlier, having those wishes put into paper, whether it just be through a simple estate plan, but outlining what you want to have done, but to maximize your benefits, making sure that you proactively do something to take advantage of some of the tax favorable status of a charity that you could benefit from.
Yeah, because at the end of the day, once the individual passes that has the asset, once the kids or whoever is going to inherit the money, just because you thought and wanted to give the money to Bethany or some other organization doesn't mean it's going to if it's not in writing.
Yeah, that as well.
It needs to be part of the plan. They need to be a beneficiary on these assets. It needs to be in writing so then that it actually happens. Not saying, I mean, I'm sure Ryan has seen just the same things I have seen. Just because the individual wanted it doesn't mean it's what happens if it's not in writing. This happens all the time. So yeah, it's important to have that set up that way. Another way to be able to, donate retirement assets. Some individuals have done very, very well for themselves. Business owners, etc. They've done very, very well for themselves. They have money that they have in, let's say, taxable investment accounts. That's all they really need in retirement, but yet they have a big 401k or an IRA or something, a retirement asset that they don't need. A good way to do it is maybe have, especially for RMDs, required minimum distributions. They keep changing the laws on them, but now when you're 73, you have to start taking money out of your 401ks and IRAs, and whether you need it or not. One way to do that is to have a beneficiary of those assets, or should I say, send those RMDs to the actual institution. By not taking the money, the required minimum distribution that you have to take out, and sending it, and instead sending it to the actual charity, none of that is taxed. So again, let's say you do very well and you wanted to give some of your required minimum distribution out of your retirement assets. And let's say the numbers, I don't know, 20,000 a year, 30,000, whatever that is. Let's say it's 30,000. And you just so happen to not need it, but you wanted to be able to do good with it. Instead of you taking the money, paying the income tax, which is going to be federal and state, then having, let's say, 20,000 in your hand to give to the charity, you can give all 30 as long as it's going directly to the charity. If you do that, that's a lot more money to the charity, and you're not paying any income tax. That's making your dollar stretch more. Why pay taxes and then send it to the organization? Send it directly there. But you can't just do that. You have to have a plan of how you're going to do that. That's another way. That's a much more efficient way to make those dollars go a little bit farther.
Yeah, I think you mentioned required minimum distributions. That's a hot topic, especially with my peers, because I'm 67,
Yeah.
and there are different thresholds at 70 and now 73. But I feel like a lot of people I talk to know about that because it's a hot topic right now because the laws just changed.
They
And
keep
so my
changing.
friends who were 71 or 72 are on a different playing field all of a sudden.
Yeah.
There's so many other facets to plan giving in addition to the stock and distributions. Things like life insurance proceeds, real estate, personal property. Are people generally aware of the values of these things and how to avoid the tax pitfalls and things that you've talked about?
Well, I'll take the life insurance part of it because I'm licensed. Life insurance part, yeah, especially if you are someone that is big on donating. Yeah, I mean, if you want to be able to maximize your dollars, life insurance policy, whether that it could be a trust like an ILET that gets it out of your estate. That could be something that makes sense. Um, but having a life insurance policy and it doesn't have to be all for the benefit of the charity. It can be 25% and the rest goes to the kids or vice versa. But having them named as a designated beneficiary to a life insurance policy, with interest rates being higher now, a lot of your bang for your buck is a little bit higher than it used to be. Because trust me, it's a big difference. I see this stuff every time. How much you can put into a life insurance policy and then the death benefit. They're giving you a lot more death benefit than they used to. Why? Because they can take your money, and with the higher interest rates, they can make more of an easier guaranteed rate of return on that money, hence giving you a bigger benefit to the charity or to your children. That is one good way to do that. So if you want to have like a life insurance policy that the kids get half and then the beneficiaries of the of charities get the other one, it's a great way to do it. It's a great way to do it.
All right. I don't know if this is something that you can pick up on or not, Ryan, but dealing with the clientele that you have, do you deal with a lot of people who have high valued real estate or high valued personal property that they're looking to do something with, or because of the situations that you're involved with, is it people who tend to be at the lower end of the net worth scale?
So I guess two things. One, at the end of the day, my job is to make them look like they're on the lower end of the net worth scale.
Yeah.
But no. So my firm in particular, we have done with respect to real estate and possible real estate values, we've done probably we've represented over 300,000 acres worth of oil and gas lease negotiations, which just by having the mineral interests, they've now the property values have sizably gone up, especially in our area. Ohio, Marshall, Belmont, Monroe, Washington, Greene counties. You've seen property values, skyrocket to the right buyer. I guess that's the other thing. If you own property, farmland, what have you, which is a lot of clients and that I'm dealing with. those farms that 20 years ago might not be worth very much because farming isn't a big activity, and who wants to buy 500 acres? Well, now, we could sell acreage to, like, I'm in the middle of selling a property in Washington County, Pennsylvania, that is 139 acres, and an oil and gas company is going to pay, like, I think I'm trying to get them to $12,500 an acre for the property and the mineral interest. So now all of a sudden, these to the eye, properties that may not be very valuable turn out to be quite valuable because of the mineral interest. So you have that. So I'm encountering it. How many people have I encountered that want to leave that property to a charitable organization? I have not encountered many. The one I did encounter recently, she wanted to leave her house and city lot in Wellsburg to the Brooke County Humane Society, who actually didn't want it. So that was a thing that backfired. But
yeah, I was going to ask you about that, because one of the things I've learned in the short time I've been doing this is that a lot of charitable organizations, whether it's the Red Cross or Bethany College or whomever, they don't want real property. It's too difficult to deal with.
Right.
Yeah, because you got to sell it. It gets tough.
Yeah, unless it was some additional acreage, around the college or around the other organization, real estate probably is not a typical bequest to a charity. Now, in hindsight, or not hindsight, I guess, but looking back, that turned out to be a big bonus to the college as it sits now, with the oil and gas money that it gets from royalty interests. So I'm not saying that doesn't happen, just doesn't happen as often with real estate. But along the lines of the life insurance and the planning, I encounter a lot of people that have worked hard, saved, especially in the High Valley. I'm not sure where the other participants are from, but particularly in the High Valley, steel workers, tradespeople who've worked and saved and have saved a sizable amount of money. But they expect that one basket that they've accumulated to accomplish 100 different things, right? Account for the kids, the grandkids, themselves, the church, the other charities, whatever. When they could look to maybe spread the wealth along amongst some different things like life insurance, maybe like one of these other charitable vehicles that we'll discuss in a little bit, those types of things, to more maximize their money, know that they can check that box and say they've taken care of it without not hurting themselves, but limiting what they may otherwise have had available to themselves.
All right, thank you. Speaking about, we've talked about a number of different kinds of vehicles. What are the most popular types of planned gifts? If you can give me, maybe in your minds, 2 or 3 different buckets of vehicles that people take advantage of.
Well, the most typical that I encounter, and I presume fairly similar with Sean here, and he can answer in a minute, but is just simple bequests. I prepare basic estate planning documents, and that's going to be the typical vehicle done through, whether it be their trust, which we would prepare for a variety of reasons, tax planning, long-term care, Medicaid planning, whatever the situation may be. Those are the most typical that I encounter. But I'm sure, there are other situations, and Sean, feel free to chime in on situations you've encountered.
One of the things that I like to use, and I might be jumping a little bit here, but one of the things I like to use that I think that are very, very They're just not utilized very much because I think there's not a lot of education in this realm. But I do a lot with donor advised funds. Donor advised, and there's multiple different ones out there. Basically, how that works is, and this happens a lot. Maybe you have a good year and you want to be able to get a tax deduction and help out a charity, but you don't know how to help. You don't know how to help. You don't know where the money should go. You don't know how much you want to give. You also don't want to give a charity a massive, large lump sum and hope they don't blow it. I hear that all the time from clients. Well, I want to give the church this, but I don't know what they're going to do with this 50,000. I don't want the priest getting a new car or something. I hear that from clients every day. One thing that's good about a donor advised fund, especially if they need a tax deduction, the money can go into the donor advised fund. And that's the tax deduction for that year. And they don't have to worry about keeping receipts for all the different charities they give to. You give the money once, and that money can actually be invested inside this donor advised fund. So think of it like a 401k line. You have multiple different investments mutual funds that they offer, and you can be as more conservative or more aggressive with that money as you want. The money goes in, it has the chance to grow with the market. You're not taxed on any of those gains. So hopefully you have more money that you can give to multiple different charities I have a client that literally gives, that's all she does. She gives there's probably 20, 30 different charities she gives. A little bit here, a little bit there. But instead of her having to hurry up and write a check to all these different organizations, you just put in what charity you want, when you want the money to go out, and you don't have to give it all in one year. You can give it out in multiple years if you want. So you can spread it. And you don't have to keep track of any of that because it does it for you, but it'll send all the checks directly where you want it. One thing, if anyone on here knows what it's like to donate to other organizations, you always get a new phone call or a new letter in the mail from another organization that automatically now has your information asking you to donate. If you wanted to be able to donate basically unanimously, you can do that too with it. They'll send a check directly from that donor advised fund directly to them unanimously. You can also dictate how you want that particular money to be spent. So let's say let's say it's to a school and you said they need a new basketball court. That's what it can go to. You can dictate where the stuff goes. So there's not really an end.
Something like that.
What's that?
Who administers a donor advised fund?
I do a few of them. So it'd be different companies. I use a U.S. Charitable Gift Trust that's run through Eaton Vance. I clear through LPL. There's a few other ones out there that I've used in the past also. A lot of them
it's
pretty
good. It's got to be somebody who's a registered financial planning.
Yeah, so you can do it without a planner, but it's easier to do it with a planner because they can help you try to set up these trusts. Not set up the trust, but set up the accounts. What's nice about it is you can still utilize a couple of things I talked about before. So for example, let's say you made a lot of money in Apple. Instead of you selling your investment at a large gain and paying taxes, you can send that amount of whatever shares you want of that particular investment. The donor advised fund sells it. They keep it's basically a deduction of 100% of that amount. There's no taxes, no nothing. And then you can dictate who gets the money, when they get the money. It's very, very nice. It's very slick. I do feel like there's not a lot of that. I have a small handful of clients that do it. There's a lot of clients. I happen to have a lot of clients that do like to give. It's tough to get them to do it because they don't know. So it's like they get afraid of doing that. And that's what we're trying to do today. We're trying to educate. So hopefully they can utilize more of these because they're very successful tools. There's a lot of very, very successful tools out
there. Okay. Anything else before we move on to other types of planned gifts? Any particular favorites that you want to speak of? And before we drill down into things like a charitable gift annuity or a charitable remainder unit trust or some of the more you know, for the novice like myself, or what is it, esoteric, things that are out there a little bit, maybe not in everybody's purview. If you want to talk about any of those kinds of things, we do have a couple questions from some of our participants along those lines that I'll get into. But if you want to generally talk about those kinds of things.
Sure. So I'll just go kind of just to everyone's aware. I have a little list here of a couple that I'll speak on. So the first is a charitable gift annuity. And so understand that an annuity can be described as a lot of different things. A lot of people hear the word annuity and immediately cringe because there's some television ad going on that annuities are bad, but not the case. But a charitable gift annuity is one where it would be an investment contract, an insurance contract between yourself and the charity, where you would use money to purchase the investment. You would get a current year tax deduction, and from there, that annuity, let's say it's for $100,000, that gift that you make, you'd get some sort of deduction that year, and then it would be calculated based on the age you are when you purchase the contract, how you would also get income for your life. And part of that payment that you get back could be tax free as well. So you could really save on some taxes, where back to the multiple eggs but only one basket. This is putting some of those eggs in a different basket. I have some money that is accumulated in value, and if I sold my stock, or I cash this in, I'm going to realize it's going to be a taxable event. Whereas if I purchased, my only real goal is to get income to subsidize my retirement. But I also would like this charity to get something. I make this contribution. They get some tax benefit. I get some tax benefit, and I get some amount of money to be calculated later, depending on how much I put in, how old I am, how long I'm going to get the payments, etc. That I would get the payment back for the rest of my life, and then the rest would go to the charity at my death. So most people today would set up an annuity with their children, meaning the children would get whatever money's left in there when they pass away. We're just substituting the charity for the child for the charity and realizing some tax benefit. And that would be with one charity in particular, because it would be a contract with you and that charity. The next would be a deferred gift annuity. So same idea as what I just mentioned, a contract with another charity to receive payments, but this would be for a period of time in the future. So you would get payments after you turn 60. Couldn't be before, but there's certain rules pertaining to this one. And the payments would go on, let's say after you reach 70, after you reach 65, whatever age you choose, you would get those payments in the future, as opposed to in the first example, you would get them immediately. There are certain limitations on this. It would have to be for a donation of $50,000 or more, and you have to be 50 or older to set one up. And then you would get the payments no earlier than age 60. In the same vein, you would also get some current year tax deductions for your charitable contribution, and you'd also be able to save on the capital gains tax. And we talk about these tax things as if some people have some understanding about that, but if not, and you have a question about the tax, just feel free to chime in and I'll answer that. But the next plan here is a charitable remainder annuity trust. So a charitable remainder annuity trust is the same concept with receiving payments. So the idea here is we make a contribution to a charity for them to get after we've passed away, and we receive income for life. The first two examples are limited to one charity. When we transfer this money to a trust to purchase this contract, we can now designate one or more charities. You get a tax deduction that year for the present value of what it is that you're contributing to the annuity. You would also be able to save on some capital gains tax. Again, with the stream of income that you would receive for the rest of your life or for a set period of time, up to you. Some of those payments would potentially be taxable, depending on how the investment is structured. So no tax going in, but you may pay some tax going out. The annuity payments that would be made would be having to be for no less than 5% of the contribution, but no more than 50% of the contribution. So you can't give $100,000 to Bethany College and take out in payments $100,000. So it's going to be structured in such a way to ensure that the charity receives something.
Mm-hmm.
Next option here is a charitable lead trust. So a charitable lead trust is it's a trust agreement where you're opening the account and depositing money so that the charity has access to it while you're living. So I would deposit $100,000 into this charitable lead trust to Bethany College. There would be some limitation on how they would be able to access it. We would make payments to them or what have you. And all that would be occurring during my lifetime. And then after my death, the remaining portion would go back to my family, or upon some stated period of time, whether it be my death, go to my family, or after 25 years, it comes back to me, or whatever the situation may be. The lead part of that name means that the charity is benefiting during your lifetime, and they're getting it now. The opposite would be true in a charitable remainder trust, where we are making the gift to the trust. You are receiving the income, you are benefiting for your lifetime, and then the charity benefiting after you've passed away. And again, that can be designated between multiple charities when it's owned by the trust.
Let me throw you a question on that then, Ryan, because one of the questions from the audience had to do with a charitable remainder unit trust. One of our attendees has such a trust. Mm-hmm. Bethany is named as the beneficiary. So it sounds like that person will be able to draw the income, or is getting the income now, but when they pass, it goes to Bethany. So once that's set up, do they have to do anything else, or is it just a done deal when they've had it appropriately set up?
When it's appropriately set up, it would be a done deal.
Okay. Can you add money to it?
You could. I don't know. It depends on at what phase I would imagine that you're in.
Okay.
But yeah, it would be possible to add to. It may be able to add it to the trust, but it may not be commingled with the already existing, maybe its own separate bucket, so to speak.
Okay. And then another question we had, I think everybody understands that most of these vehicles are good because there are tax advantages. Mm. One of the things that I'm thinking may be a bad thing is that they're all what we call irrevocable. Once you've entered into this contract to create the annuities or created a trust, can you undo it, or are they locked in for the extent of your life?
So they're there are certain instances where you're able to change them. Obviously, you know, the charity goes under or changes, that would be an obvious ability to change or undo. But in our normal irrevocable estate planning trusts, we oftentimes have the grantor of that retain what we call a power of appointment, so that they could add or change a beneficiary. But to the extent that you have a contract, like one of those annuities with that company, your ability to unilaterally make changes becomes complicated.
Okay,
Yeah.
okay. I'm sorry, Sean.
Because it has to be, because it's a lot of these ones, and especially right now, you know, in the annuity world, especially with interest rates being higher, I would assume a lot of these annuities are getting much more advantageous to what the payouts can be and everything. And not to be the estate planner room, because I am not, Ryan is. But one of the major benefits of doing some of those now would be, one, interest rates are higher, so the benefits should be better. But two, most likely would be, especially for estate planning standpoint, you usually can get a pretty good discount on what you can do with them. Meaning, if you're trying to keep the money or try to, you know, later on in life for your kids, you can usually get a pretty good discount on what the asset's worth for estate planning purposes. Am I right, Ryan?
In a state tax world, I would say yes. I don't know how that would play in my nursing home Medicaid world, but
No.
but in general, yes, you're right.
Yeah.
All right. Well, no more questions at this point from the audience, but let's talk about one last thing. Are there gifts that you can use to protect the assets in any way? Like I'm thinking of a life estate, for example, where you want to leave your house to the college or to whatever your chosen charity is, but you want to live in it till you die. I mean, are there ways to set that kind of thing or similar vehicles up?
Yeah, so now that's my wheelhouse. So so in my normal Medicaid estate planning world, everything that I do, gifting is generally bad. Because what I'm doing on the other hand is I'm asking somebody else, the state, the government, however you want to look at it, to pay for my exorbitant long-term care costs in a nursing home. So it wouldn't be fair to tell them that I had $100,000 and then they would tell me, well, Ryan, you have too much money. We're not going to help you pay your nursing home bill. And I said, wait a sec. And I give Sean $100,000 and I come back and say, oh, don't worry, I don't have any anymore. The Medicaid agency is going to have an issue with that. Same thing, whether it's to Sean, to a charity, to anything, in general, on the surface level, the Medicaid agency will take an issue with that and call that an improper transfer. Same thing with a life estate deed, anything like that with your real estate. I'm sorry, I have a crying kid that is in the other room. But when we own our piece of property, we own the right to live there today, tomorrow, for the rest of our life. But when we do a life estate deed, we sever that interest. And I own the right to live there now and tomorrow. But after I die, my kids have that right immediately. And they have a present interest in that life estate, subject to my right to live there. So in Medicaid world, based on my age or the client's age, when they did a life estate deed, there is some calculation to determine what the ownership interest of the life tenant is and the ownership interest of the remainder person is, and that value given to the remainder person is an improper transfer. Okay. So all of that we can accomplish by planning ahead. In order to get long-term care Medicaid benefits, we have to meet 3 simple criteria. We have to be in the nursing home. We have to have less than $2,000, and any gifts that we had made have to be outside of, as of right now, a 5-year look back period to our application date. So while it may be that we wanted to give it to the college or to another charity, if we had done so within the 5 years leading up to a nursing home stay, you run into the possibility that that gift be looked at improperly.
So it's like a bankruptcy where a person or a company that wants to declare bankruptcy divests themselves of cash and all kind of other assets to keep it out of the bankruptcy court. Bankruptcy court has the ability to void that and grab that money back. Sounds like the same thing.
Right. So whenever you would apply for a long-term care Medicaid application, you're going to submit 5 years essentially worth of records. And each state differs. Medicaid is a federal program, but it's administered by the states individually. And so where we live, each state treats things differently, looks at things differently, interprets things differently. So Ohio is way more aggressive and takes a more strict interpretation of certain regulations. West Virginia, by comparison to the other states, has a greater number of people receiving government assistance. So we actually take a more liberal approach and let certain restrictions maybe slide more so than Pennsylvania or Ohio would. So the ability to, if you wanted to make that gift inside of any of these plans that we're talking about, it still has to be done in conjunction with your overall long-term care or estate plan. No matter how much money you may have, I'm sure you'd rather it go to a charity or to your children or to friends or family than spend $12,000 to $15,000 a month at a nursing home. So all of that can be done, but in the proper vehicle.
All right, Ryan, thank you. I noticed that we're getting close to the top of the hour, and with these technology vehicles, I'm never sure that they won't just shut us down right at the top of the hour. But I do want to wrap up and just a couple of closing points. Obviously, one of the things we've talked about is that planned giving is not just putting together a will and making a bequest. There are a myriad of other options that we've talked about tonight. And, while these aren't topics that people necessarily want to talk about, at least these concepts allow you to, go against the old adage that the only thing in life that's sure is death and taxes. Can't get out from under death, but you certainly can do some work to avoid taxes and use that to the advantage of the charity, which hopefully will be Bethany College in some instances. And working with experts like Sean and Ryan, you can take full advantage of these kinds of things. And with that in mind, what I want to do here is share my screen so that everybody who's joined us can have contact information. As I said, this is going to appear on the Bethany website in a form of a recording, but hopefully you all can see this on your screen now. The contact information, Ryan, I don't know if you and Sean can see that I've shared my screen with your contact information.
There we are.
And that will give everybody the chance to make a note or two. Gentlemen, really appreciate your time tonight. Participants, audience, thank you so much for joining us. We hope to do more of this kind of thing in the future. And you can always feel free to look for that recording on the website in a couple of days so that you can refresh your memory on what we've talked about tonight. Again, thanks to everyone.
Yeah, thanks for having us.
Guys, very much enjoyed it and appreciate your being on with us. Take care now.
Yep.
Yeah.